This video gets into a lot of the more conventional technical analysis indicators. So we're going to walk through a bunch of charts, and I realize that any chart may show you 3 or 4 different things that I want to talk about. So we're just going to go chart by chart, and I'll point out some stuff as we go through them. And hopefully this will give you a good idea about some of the more easier, I'll say, technical analysis indicators and techniques you can use to really analyze what's happening with the price of a stock. All these charts are provided by bigcharts.com. None of this is trading advice, it's all opinion. But let's get into it now. What I want to show you on this chart is you can almost imagine a red line across here at the $3 level. That's a support level that every time the price gets away from it and starts coming back down to it, you're going to see a little bit of an uptick in how much trading volume is going on. And also, you see it's at a round number price, $3. A lot of less experienced investors will do this, and also there'll be a conglomeration of a lot of the traders all trading at the same price point. People sell at $3, they buy at $3, they sell at $3.50, $3.75, $4, $8. You get the idea. You're not going to have a big build of people all who want to sell the shares at $3.22. They're going to gravitate around round number pricing, and that's why a lot of times with thinly traded stocks like these, you'll see that there will be a support level at a round number price, $3, or there will be a resistance level at a round number price. And there's a mild resistance level here that you can see at $4. So the price was being held above 3 by more buying demand every time the price approached that level. But it also wasn't quite strong enough to get past the resistance level, which is right across this $4 mark here. And keep in mind, this doesn't apply to every stock where I say, okay, a round number price around $3 could be a support level. That's not what it's based on. That's just what it's based on with this specific stock we're talking about in this specific chart. But it is also pretty common when it comes to a lot of stocks that are, as I said, thinly traded. But you can imagine if there's a red line here at the support level, and then a red line here at the resistance level, that's why the stock was range bound for a while. It got harder to break into cruising altitude when it approached $4, and it got easier to maintain higher prices every time it declined towards $3. And this is a chart of GVP. Now, when there's a trend, you can see here this is an uptrend, which then became a downtrend. At any point during a trend, the most likely direction for the price to go is further in the trend that it's already in. So if you're looking at it here, wondering where it's going to go next, it's probably going to go lower. If you're looking at here, wondering where, it's probably going to go lower, and probably going to go lower. And it'll keep on doing that until eventually something happens where it breaks out of that. Maybe you can see that there's almost a mild support level here, the $2.60 range, besides this one day where there must have been a big overwhelm of a lot of selling pressure all at once, which dumped the stocks like that. It's a temporary dip. Besides that, there is some support at the 260 level, and that would have potentially made this into a double bottom, where if that support did hold up, and it probably is more likely to be trusted because there's more trading volume at that time. You can see that generally the trading volume of the stock is pretty low. It's nothing major, but there was a little bit of activity as the stock price approached that resistance or that support level. So if it bounces off of there and gets away from it, and then kind of comes back to it again and bounces off of there, that's a double bottom at that price, and it's generally a very optimistic sign for the stock price going forward. Then you can see here there's a support level at 310. That's why it looks like if you took a knife, you could cut off all the prices, all the wicks of the candle, that the lowest price it's hitting here is at the 310 level. And it's not as though the support is all showing up at $3.11 or $3.14 or $3.02. It's a round number price, and that's why you can put a little bit more stake into the fact that it may actually be a support level there. But at the same time, you've got a resistance level at 360. I don't know if you guys can see that, but if you drew a red line here and a red line there, that's what is keeping the stock price higher above those levels and lower below these levels, so that you're going to be range bound for a while until either the stock eventually gets enough momentum and upward strength to break through the resistance level, in which case the stock will probably do very well in the short term going forward from there because it's a breakout. Or if the stock price collapses beneath the $3.10 support level, that's a breakdown, and it will probably keep on falling lower from that point. Now this is ONCS, and you can see the support at the 90-cent range here. Just imagine a red line going right across that level, and it's going to be showing you that the price might have approached the support level, but then it responded or bounced back, and then it took another run at it and it bounced back. And if that support level keeps on holding like that and the stock eventually does get things going in the right direction, that will generally be the lowest price you'll see for the shares for a long, long time. Now this is a gap higher. You can see gap lowers, gap downs, or gap ups. This is where the stock price closed, and the next day it opened at a lower price than where it closed. That's a gap down. Gap up is the opposite. It opened at a price higher than when it closed the day before. And you can see this huge trading volume spike. This is a very thinly traded stock, but there's a huge trading volume spike along with the gap higher. And it wasn't based on earnings, because you see the earnings were higher, but they were actually, looks like about 2 weeks before that point. But something happened. You can look into it in the press releases. I'm sure it's easy to find. But you can see that there was a ton of trading activity all of a sudden. 50 million shares on this day, where the average is probably closer to 100,000 a day. And with that, with a gap higher, something happened that's monumental with this company. And then your job as an investor is to figure out what that is. And if you believe that it's going to be like a wind at the back of this stock and take it to much higher levels, it's going to be sustainable. It depends. Is it a big contract with Disney or something like that? Then yeah, then it's going to be beneficial for a long-term time frame. But you don't know what it is just by looking at the chart. And that's why you have to get into the fundamental analysis too, which is what I've been preaching on from the beginning of this course. So you put it all together basically. And you can imagine that there's probably a support level at 160 here. And if that holds up, that makes it an attractive opportunity in terms of if you want to get involved with a stock like this is opinion, not advice, and you bought it here at $1.63. But then you had a stop loss limit where if it fell to $1.55 or anything below that, you immediately sell, you take a small loss. But if it does stay above that price, it's very likely to start going a lot higher, and that's going to be a pretty profitable trade for you. This is NSU, and it's got pretty good trading volume here. I'm looking at about 300,000 shares a day, which is good enough that you can rely on technical analysis with a stock like this. And that's why when you see a triple bottom like this, it approached $2, it approached $2 again, sprung higher again, it approached $2 again. That could potentially be a triple bottom, that if this $2 support level holds up, then the next move for the price of these shares is going to be much higher. But you can see that there was a little bit of resistance around the 250 level. The shares are having a hard time getting above that. They did break through there during the day for 2 days here, but couldn't hold up, and they fell down. But how far did they fall? They fell to the support level. So they're probably range bound between $2 and $2.50. That's the low, that's the high for now. And eventually, the stock either has a breakdown and falls beneath the support level, or it has a breakout and it breaks above the support, above the resistance level, and that generally is really optimistic for the future direction of the share price. Now this is Real Networks, RNWK, and it's breaking my heart because it's a great company, and we selected it somewhere around here and here, I don't know, and it's lower than when we picked it, not by a ton, but it's a good company. We think it will turn around, but that's not the point. This is technical analysis of the chart. It's going to try and find short-term opportunities for you more than long-term, which is what generally the fundamentals will show you. Technicals will show you more buying opportunities and prices to get involved with shares at. So you've heard the expression, don't try to catch a falling knife. And you would have seen this a lot all the way down from here, because people would have seen it here and been like, wow, it's a lot cheaper than there, so it's a good bargain. Same with there, same with there, same with there. averaging down, buying more all the way down. Don't ever try to pick the bottom. You wait till the stock proves to you it's reversing and going back the other way. And as well, you can see that at this 390 price point and then closer to $4 is sort of a little bit of support here, not a ton. But also, I wanted to show you this topping out pattern because the stock has done very well, bottomed out here, and it trended higher, but then it couldn't quite get above this level. And since it's at $4.90 to $5, this is kind of like a resistance level. They don't think the stock is worth anywhere in the $5 range, $5.50, $5.25. They're giving up on it at $4.99 or $4.90. And you can see that it had a lot of momentum going into here. Then it traded sideways for a while. For a month, it couldn't get above that price. And at that point, by the time you're almost going into the third week of that, you must understand that it's obviously not going to break above that level unless something monumental happens. And then once it starts not being able to break above that resistance level, that's just a dangerous sign for it, because then you've got all this downside here, and this is exactly what happened. And in terms of the trend, this trend has been downhill for a while. And this is a aberration where it sort of bounced a little bit. It's not a dead cat bounce, but it is a little bit of strength that came back into the stock. But then it leveled out, could not break above that level, and it sort of collapsed from there. It tried really hard to break through, and then it failed at that, and so it just sort of collapsed. This is ATEC, and this one I'm going to let you look at this chart for a minute and see what you can see in all of this. Because I'm going to show you something that what you want to do too is you keep an eye on how many shares traded hands. So if you say, okay, from this day, this many shares traded, this day, this many shares, and you add it up. And if all of these shares add up to a significant turnover in the shareholder base, then that means that you've got a lot more shareholders that are new investors, and as such, they're less likely to sell the stock, and also they just bought because they think it's going to go a lot higher, so they're going to be holding on to their shares. That constrains the supply of stocks that are available to be purchased, while when there is buying demand, such as you see with all this trading activity, then it's going to push the stock price higher. It kind of crested out at $4.25. That was sort of, I wouldn't say that's a resistance level, but that's where it topped out. It wouldn't get above there. But I want to show you something a little bit more, what I consider maybe interesting, for lack of a better word. This is a sort of consolidation pattern that looks like it's setting up here, where the stock price comes down, trades sideways for a while. This is a cup and handle pattern. So the stock price comes down, trades sideways, spikes up, drops back a bit, and then trades sideways. This implies that the next move for the stock, based on the consolidation, the way that it played out, it shook out all of the investors that want to get out of the shares, and it also has traded like this because there's a lot of investors who want to get into the shares. And then generally, after a cup and handle pattern, the next thing that happens is the stock price jumps higher. Let me show you this in an article that John Wiley and Sons had me write for them. Okay, consolidation patterns in penny stocks. You can get this article too through the links we give you, but here's a little bit of details about how it works. There's 6 stages in the consolidation pattern for the cup and handle. Okay, now let's zoom in a bit so you can see better. Okay, the 6 stages of a perfect consolidation pattern. See here, stage 1, trade sideways, maybe a little bit of support there. Stage 2, trades down. Stage 3, trades sideways across the bottom of the cup. And if it does this for a while, this is a point that's most important. There's a lot of shareholder turnover through this area during this time, then that's going to really set this pattern up to work out really well. A lot of shareholder turnover, and as I said, a lot of the shareholders are now newer investors in this company, so they want to hold on for longer. They've got a better outlook for the stock. And then what happens, stage 4, it goes up the other side of the cup, so down, across, and up. And when it comes up, it goes up, and then it drops back just a bit. and then it trades sideways for stage 6 of the cup and handle pattern. When that happens, and you find this pattern and you're accurate with it, and there's enough trading volume to support technical analysis, which generally with lower price stocks there's not, but in this case there was. If you find this pattern, it can be very profitable to trade, because if you buy into this stock, you won't know it's a consolidation pattern until the stock drops down and starts trading sideways. So this is where your buy point would be during the handle of the cup and handle pattern. And then generally you get the benefit of all the upside moves. But now I want to show you another chart that's going to explain something I'm trying to tell you guys. You can't trust technical analysis if the trading volume is not significant enough. Case in point, GIGA. This is a thinly traded stock, trades about 20,000 shares a day, something like that. I don't remember exactly. But you can see that this looks like almost a cup and handle consolidation pattern. So it's trading sideways, drops off, trades flat through here, pops up higher, comes back a bit, then trades sideways. If you were to buy right here, trusting in this chart signal, you would have got wiped out. It's implying that the next move for the stock price will be much higher from that point, right? But first of all, this was not enough of a shareholder turnover. That's why it wasn't very flat. It's kind of like a round bottom. But also, just not enough trading volume. It could set up a perfect pattern, and you can't trust it because there's just not enough going on with the stock. If it trades 20,000 shares in a day, and it's trading at 35 cents per share, then how much is that worth in terms of total value? About, what, $7,000 or something like that per day? That's not enough. And that's why this pattern broke down. It looked like it was doing one thing and it completely wiped people out. And it's just a messy chart. There's not enough trading volume to even imply that there'd be a support level here. That's why it didn't hold up and it broke down. So that's kind of what happened with that. Even though it looks like what would typically be believed to be a cup and handle pattern, it would have steered you wrong. That's why I keep warning you guys about this. Although even with a thinly traded stock, you will see things like this where it's a resistance level right across there. That's at the 90-cent price point, and the stock had a lot of trouble every time it approached that price point. And it doesn't matter, because even though it's so thinly traded, you could still have a lot of resistance or support for a lot of these smaller stocks. And the reason I want to show you this chart, I want to show you something very specifically, but what I'm going to do is I'm going to zoom in a bit so we can see what we're looking at a little bit better. This is a 6-month chart now, and the stock kind of rounded out here and went from downtrend into an uptrend. But what I want to show you on this chart is the topping out pattern, where it had a strong uptrend, 1, 2, 3 months. It was going higher, but then it got to a point where it continually fell back or could not quite break through. And even when it would approach 290, it would not get through there. But with the exception of this one day, and for a little bit on this day, it just was where the buying was dying out. There was no more buyers. And so you'll see a stock perform really well until it's just exhausted. And that's when it will then lead to this kind of collapse. And that's why also, if you bought it here, you would want to have a stop loss order somewhere around here, that if it did start falling, going the wrong way, you would get out and you would take a small loss at that point rather than ride it all the way down as the majority of investors would have done. But even this one so far today, it has only traded 1,689 shares. So you can't really put a lot of stake or weight into any of this kind of stuff, not even things like the RSI or the money flow. It's kind of meaningless if there's just a ghost town here, if not a lot of people trading. And it's sometimes a little bit misleading where it looks like, wow, this was a lot of trading volume, because look at how much higher it is than where there's less trading volume. But the point is, this was low, and this wasn't as low, but it was still low, because we're talking about 250,000 shares on this day. The next day was maybe 50,000. It's too low. It's too little. You can't trust anything you're going to see on this chart. And this is MVIS. And what you're getting here, I'll show you a couple of things. Gap higher, and then another gap higher 2 days later. And the thing about gaps is that they're trying to show you the momentum. It's kind of like getting in an argument with your kid or your wife or whatever, and they slam the door when they're done the argument, you can tell how upset or pissed off they are based on how loud or how hard they slam that door. Some slams are different than other slams. Some slams are just trying to say, that's the last thing I'm going to say, and they slam the door and they make a statement. And other times they slam the door and you say, oh no, like, you know, you're dead. Like, you really made a mistake, and they're pissed off, right? So there's a little bit of subtleties there. That's kind of what gapping up and gapping down is like. When a stock gaps higher a little bit like this, it's a good sign. Sometimes shares will gap very much higher, and that's even more significant. That's just one way that I sometimes like to think of it, is sort of adding a statement to the momentum of the stock. And this is a breakdown. So the stock price is coming down in this downtrend, but then here it sort of just collapses. A little bit of capitulation almost, where everyone's just dumping the shares. And a lot of times too, it's based on an event such as the earnings report, which came out there, but you can see it's an up arrow. So it's the earnings were better than the period before, but they must have been expecting better earnings, or when they released their earnings, the company made a statement which implied that future operations may be difficult, or there's other obstacles that they're going to be facing. And so the share price just collapsed like that. And I want to show you the MATR chart because I want to show you when a stock gets range bound. You can see here, you could almost imagine that at this $2.40 price point, there's a little bit of support there. It looks like it was sliced right off there. And then you could also imagine that there's a bit of resistance at the $3 price point. So you've got $2.40 on one side, the higher end is $3, and the stock might be range bound within that range for months until something happens, which it either collapses or it breaks out of that range. And if you're watching to buy it when it comes down to the support level, watch very carefully, because if it breaks below the support level, something's going on that could be bad. But if it holds up there, then approaches the resistance level. If it could break through that, then it's off to the races with that stock. What I've got to do too, there's a lot of other things I'm going to show you on these charts, especially when we get into the Japanese candlestick charting patterns. Those are the most important ones. This is just a brief overview of some of the more common on-chart technical analysis indicators. There's all sorts of other stuff too, like descending triangles and all that kind of stuff, and you can get into that if you want. It doesn't really apply a lot of the times for a thinly traded stock or a smaller stock like a penny stock. But we are going to add a new feature. You guys know this is a living course. I'm going to add a new feature to the course where we just go through stock by stock by stock, the full procedure of looking at the chart and getting into the financials, fundamentals, and then look at everything, even investigating, showing you guys how we look into a company. We're going to add that to the course in the coming days, so watch for that. You're going to like that a lot. And now we'll just keep on rolling. Let's get into the Japanese candlestick charting patterns. These are fun. You're going to love them. And they tell you more about the psychology of investors than anything. And they're more useful in that sense than anything.